In today's presentation, I wanted to specifically talk about some of the things you as realtors can deduct, some of the strategies there are from a tax perspective, and at the end, we're going to have a Q&A, so if you have specific questions, I'd love to help answer those as well. All right, so these are going to be the three topics from the presentation. So part one, I wanted to talk about some of the deductions for self-employed realtors. So I'm going to focus on things that we notice people forgetting or not adding on their tax returns. So as realtors, I'm assuming a majority of you are receiving a 1099 and are self-employed. And so we want to talk about the deductions that we want to make sure everyone's taking advantage of, because obviously we want you to be paying as little amount of tax as possible. In part two, I'm going to talk about creating an LLC. Should you elect S Corp tax status? Talk about the pros and cons there and why it might make sense to do so. And then in part three, I wanted to dive into the real estate professional tax status for investments. And we're going to talk about how you can offset income with losses in real estate. So part one will be the deductions for self-employed realtors. And on the next slide, I have some of the common deductions. Some of these I'm just going to quickly go over, but I want to spend more time on others. So, if you're receiving a 1099, if you're self-employed, by default, you're getting this 1099 in January or February, and let's say the top line box one is $50,000. If I was an employee and I made $50,000 in compensation, my employer is withholding, that Social Security and Medicare tax and also some federal income tax. So if you've ever been an employee before, you know that maybe you get paid $1,000, but you're only receiving $700 or $800. You're getting a net amount, and that's because you're withholding federal tax. You're also withholding Social Security and Medicare, and your employer is matching, so they're paying the other half of your Social Security and Medicare. So that adds up to 15.3%. When you're self-employed and you get a 1099, you're on the hook for all 15.3% of that. So if you just get a 1099 for $50,000, you put that on your tax return with no deductions, you're going to get charged 15.3% on $50,000, which obviously is a big number. And then in addition to that, you're going to have your federal income tax. So you're really paying three taxes: Social Security, Medicare, and the federal income tax. So that's why deductions are going to be super important, obviously. So we always want to go over your deductions here. Make sure if you're getting a 1099, you're writing off things like advertising, your supplies, dues and subscriptions if you're paying for Adobe or QuickBooks or some type of subscription service, realtor subscription service, bank charges, credit card fees. A big one is auto expenses. I wanted to touch on this. We can either take the standard mileage deduction, which now is 70 cents per business mile. So that's going to be great if you have a less expensive vehicle, you drive a lot of miles. Then what we're going to do is we're just going to say, hey, I drove 10,000 miles in 2025 for my realtor business, and that's a $7,000 deduction. We take the 10,000 business miles multiplied by 70 cents, and that's your deduction for the year. But maybe you have a really expensive truck, it's 100% business use, and you don't drive quite as much each year. Then it might make sense to take the actual method, and that's where you're taking depreciation on the cost of the vehicle. You're writing off the actual fuel expenses, repair and maintenance, oil changes. Even if the vehicle is only 80% business use or 60% business use, we can allocate that actual cost based on the percentage as well. So we always want to look at it both ways, but once you pick mileage, we need to stick with mileage. We don't want to flip back and forth year to year. So per vehicle, we want to stick with the method we select. So just something to mention. Other things people don't always think about would be like go ahead. Sure. Yeah.
So within the depreciation, how is that calculated based on mileage of business use?
So yes, if we're taking the actual method, we would say, what is my business usage of this vehicle? Maybe it's 100%, in which case we could depreciate all of it. But if it's not, the way to determine the business percentage is by mileage still. So you kind of want to keep up with mileage regardless. But if we're taking actual method, we would say, okay, I drove 7,000 miles for business. but I drove 10,000 total miles this year. So that's 70% of the depreciation. So yeah, you take 70% of your, and so in other words, you keep up with all of your fuel receipts for the whole year, and we'd multiply that by 0.7 and take 70% of your fuel, 70% of depreciation, 70% of insurance, 70% of oil changes, tires, repairs. So yeah, that's how we would do it.
So I put my rules for advertising all over my car. Do I get to write off my car more because it's advertising, or just the cost of putting the wrap on it?
Yeah, it would just be the cost of the wrap, because even though it's always on the car, you might still be using the car personally. So we would write off. It is advertising, that's true, but technically we're supposed to.
If you pays me to put for advertising on my car, then I could charge her amount of advertising costs, and she could write all that off.
That's true, but then you would want to include that in income on your taxes. But yeah, that is true.
Okay. I just wondered how that works, because you see that they just put information on the vehicles. It's not as advantageous if all they can write off is the cost of doing that. So.
Right. Yeah, so we always tell people, if you have a less expensive car and you're driving all over the place, right, mileage is oftentimes the better way to go. It's also a lot easier. And when you sell the car later, there's no depreciation recapture. If you take the actual method, so this is an important thing. If you take the actual method, and let's say we say it's 100% business use, and I paid $50,000 for this car, I depreciated all of it. Another caveat: we can accelerate the depreciation, so we can take all of that in the first year as opposed to spreading it out over a few years. But let's say we fully depreciated it. Now we're going to trade it in for a new business vehicle. Well, unfortunately, because we've depreciated it and taken that deduction, we have to recapture that as income in the year we traded in. So that's another reason why taking the actual expenses could be viewed as a negative, because later down the road, when you trade it in, you're going to get to write off the new business vehicle, but you're going to have the recapture of the trade-in. So you're only deducting a net value. So that's just something else to mention.
So here's on that. Whatever they give you for your trade-in value, you have to count that. If they're giving you $10,000, that's $10,000 in income, correct?
Yes. So if we wrote off a vehicle for 50, for example, in 2024, but then 3 years later we trade it in for 20,000 and we get a new vehicle for 50,000. So on the new vehicle, we can write off that 50,000. But we're going to have a depreciation recapture of that trade-in of 20,000, and so that's going to basically be income on the tax return. But we're going to have the new vehicle depreciation. So you're getting a net deduction still, but it's not. I guess that would be the negative of the actual method, because if you only do mileage, when you trade it in, you move on to the next vehicle.
You're going to get into the LLC side of the car buying, correct?
Yes, we'll talk about LLC here in just a minute. Any other questions on auto?
Because we were talking about accelerate depreciation and take it all the first year. That's under the ways of
No, that's what it is.
Well, you are right in that even a sole proprietor, like even if you don't have an LLC, you can, and that's something we're getting ahead of ourselves, but in the next topic, I'm going to talk about this. But even if you don't have an LLC, you don't have a DBA, you're just a sole proprietor who gets a 1099, you can still deduct all of these expenses if they're applicable to the 1099 income you received. So with the vehicle, if you have a vehicle that's above 50% business use and you take the actual method, if the gross weight is the 6,000 pounds or more, we can accelerate and do the Section 179 depreciation where we write it all off in the first year, as opposed to spreading that out over 5 years. If it's under 6,000 pounds, we can still accelerate some of it, but not necessarily 100%. So you were on the right track. Okay, so the other things, internet, telephone, we see a lot that people, they're doing a good job keeping up with their business expenses, but they have a cell phone and they have an internet bill at home, and it's kind of intertwined with personal, so they don't think to add this. Technically, we're supposed to allocate it similar to the vehicle, where we'd say, okay, it's 50% business use, it's 80% business use, and we would take a percentage of the internet and cell phone. However, we've seen that, or really, you can take 100% of these because that can having a cell phone or having this internet at home is the main purpose of that is your livelihood, is your business. So instead of adding these as part of the home office deduction, which we're about to talk about, you can take these at 100%, or you can be conservative and take 80%, or kind of allocate it based on phone logs and how long, how often you're on the phone for business versus personal, and so on and so forth. Meals, that's another big one. When you go out to eat, if it has a business purpose, we can take 50% of your meals. So a lot of times what we would suggest is if you do create an LLC, you can put your children, your spouse on your board, and then every time you go out to dinner with your spouse, if you can have a board meeting, incorporate some business conversation, and just keep track that it's actually a business meal, you can deduct 50% of that meal. Yes.
So for a while there, it was 100% during the COVID thing. Is that now?
Yeah, during COVID, they upped it to 100% for 2 years to help the restaurant industry, or just to give that, I think it was 21 and 22. It was just like a 2-year period, but that's back to 50%, unfortunately. Travel, that's another one. If you take a trip, even if it's a vacation, if part of that vacation is business related, then we can write off 100% of the airfare. And we can write off the hotel days that are business related. So if you and your family go out on a vacation, but maybe there's a conference there during that time that you go to, or you're there to meet with a potential client or view rental properties, then we can potentially write off 100% of the travel costs or the airfare costs, and then 100% of the hotel costs for the days that were business related. And then the personal days, we wouldn't be able to write those off as a travel expense. But that goes for meals as well, the meals that are business related, so on. So travel can be a great one. Another reason, which we'll dive into on why it's a great idea to potentially add family members to your LLC board of directors. Home office deduction. This you may be familiar with. This is where we can allocate by square footage. So, if you have a dedicated office space at your home, we could say, hey, I've got a 100 square foot room here. That's my home office. And my entire house is 2,000 square feet. So we would take 100 square feet divided by the 2,000, which is 5%. And then we can take 5% of all your annual home costs, such as mortgage interest, property taxes, all your utilities, electric, water, your homeowner's insurance. We can even take 5% of depreciation on your home. So you can get a few $1,000 deduction for your home office deduction each year. So this is a great one. If you don't want to keep up with all those numbers, you can also do the simplified method, which is just $5 a square foot. So if you have 100 square foot home office space, you would just multiply that by $5, and then that would give you like a $500 deduction. But usually it's worth it to come up with those actual costs, because it's going to be a lot more than the simplified method. Okay, this last one is super important, we like to mention. If you have children under the age of 18 and they can somehow work for your business, whether that be modeling, if they're 2 years old, they can potentially do modeling, photos for the website. If they're older, maybe they can help clean up houses before you do a showing. Any way you can find actual work for them to do, you can pay them as though they were an employee. But the benefit is you get to deduct that, and they don't have to pay a dime in taxes as long as it's less than the annual standard deduction, which is $15,000 per person. So if I have a 12-year-old and I need some extra help, we're showing houses and there's a little bit of like organization and things we have to do. My 12-year-old can come help me for 2 hours. I can pay her a reasonable salary, so maybe $30 or whatever that would look like. But then I get to deduct that, and at the end of the year, maybe I've paid her in total $10,000. That's a write-off for me, so I'm saving tax on $10,000. And as long as she hasn't earned more than $15,000, she doesn't need to file a tax return. I don't need to pay She doesn't need to pay a dime of taxes. And because she's under the age of 18, there's not even Social Security and Medicare tax. If they're above the age of 18, then you'd have to actually run payroll. They would have to withhold that 15.3% we talked about. But when they're your own children being paid through your own business, then that's a great way. We always, we want to say, don't pay taxes and then give your children money. Let your children work for your business. Gain that great responsibility throughout their youth, and then they can save for college or use it for sports or whatever it may be, and you're getting a deduction. So that's tax-free money. So that's a really good one. Any questions on
Over 18 for adult children?
I mean, you can still pay them. The benefit would be you're potentially shifting income into a lower tax bracket, so if you guys have a lot of income, you get all the way up to the 35% tax bracket, but your kid is 20 in college, you could pay that child $20,000. So you're saving 35% on $20,000, but then they're paying taxes maybe at 12%, so you're still shifting the money into a lower tax bracket, but they would technically have to pay that Social Security and Medicare and file a tax return at that point. So they might. So in other words, they would owe some tax, but it would still likely be a lot less than what you might owe if you hadn't done that. So,
But only your personal children, correct?
Yes, that's correct. It's a specific.
Right off your kids.
What kind of documentation, like what kind of proof?
Yeah, that's a great question. So the two big things, or really the three big things, we want to have some type of employment contract. So really just something on paper. It doesn't have to, it can literally just be something you've typed up on paper and have them sign. These are your duties. We're going to pay you X amount per hour. So you just want to have some type of paper trail of this is what we decided. And then it needs to be reasonable. So like, we don't want you to pay your kid $10,000 because they helped you one day. It needs to be a reason. What would you actually have to pay an employee to do these tasks? Yeah, you'd want to keep up with their hours. Exactly. You'd want to keep up with their hours or the tasks that they're doing and kind of come up with a reasonable cost that it would cost you to pay someone else to do it. Oh, nice. Yeah. Oh, the third thing though, we want to have a bank account for them. So it is good to actually transfer the money to a bank account for them. And yes, go ahead.
So in regards to that, would as far as you have let's say you have the employment contract with them, and then you have an automatic. They help you continuously, like it's an automatic. These are the things you do. If you don't do those, you don't get paid. But if it was an automatic withdrawal from my account to their account in a certain sum once a week or once a month, would that stand as proof as employment into their account?
Well, yeah, you want the money to move. So that's one thing. You want the money to transfer to their bank account. But two, you want to have something like I was saying on paper, like we've agreed that you're doing this, this, and this, and getting paid X amount per week or X amount per job. And we would just want it to be reasonable.
So it wouldn't be, I wouldn't have to receipt necessarily every time they did something, but if I had an employment contract that said, you are doing da-da-da-da-da-da
Yes.
for this amount.
Mm-hmm.
Gotcha.
Yeah, exactly. So, yeah, it's a great deduction. One last caveat I'll throw in there is technically they're an employee when you do this. So normally you would have to file a W-2 for them, but you don't have to because as long as you're paying them less than the $15,000, they don't owe Social Security and Medicare tax, and there's no penalty for not filing a W-2. So anyway, I just wanted to mention that they're technically an employee, but you don't have to worry about W-2s, 940s, any of that stuff.
So what if they aren't old enough to have a checking account? Like if you said we use a smaller child for model income.
Yeah, you can create you can still create an account for them, but it's like under you. It's I can't remember the name of it, but the bank.
At the bank, you can create you're the custodian of their account,
Oh,
and so they can have it, but you have access to it.
Okay.
Yeah.
Okay.
Cool.
Where do you represent that on your
Usually, you would either deduct it under the wages column or outside services is fine too. Yeah. So, like on the schedule, if you're filing a Schedule C, or if you're filing, so this is important actually. This is applicable for LLCs or like if you're a disregarded entity, which we're about to talk about. But if you're an S Corp, it doesn't work this way because the S Corp is viewed as a separate entity from you. So that is one caveat I should mention. This works for. Does everyone know what a Schedule C is? Do you guys know how you file? So if you're doing a Schedule C, or if you have another business where you're doing like a rental property and you have anything on your personal tax return, the farm schedule, the rental schedules, you can pay your kids this way and deduct it. But if you're an S Corp or a C Corp, unfortunately it doesn't work, and they would have to pay the Social Security and Medicare. You could still do this. You could still pay them up to the $15K. They won't have to file a tax return, but if you have an S Corp, you'll want to put them on payroll, and you'll basically be paying that 15%. But it's still good because you're potentially shifting money to a lower tax bracket, and again, instead of paying tax and giving them an allowance or paying for their college, you're kind of letting them earn it themselves. So I know this is a lot. Any other questions specific to some of these deductions we've gone over? Okay, I'll talk, and obviously this is not everything. These are just some of the more common ones that I was thinking of with realtors, but something important to touch on, anything that's a direct expense for what you guys do to earn your income, we want to make sure we're deducting it. So in the next...
So just say I'm going to Florida next week, and so what do I have to do to make it business?
So it would need to have a business purpose. It doesn't have to be 100% business, but you'd want to be able to justify, I went to a conference, or I met with a client, or I was there to view like rental properties that I'm probably going to invest in. You would just need to have some sort of justifiable purpose.
And does it have to be in America or?
No, it can be outside of America. Yeah, it can be anywhere.
She's going out wide. She'll decide today she's getting on a plane tomorrow. I've seen her do it.
I think Will had a question.
So to piggyback on that, so let's say you go to Florida, if she were to walk into a local real estate office wherever she's going to learn about the Florida market for educational purposes, that's like one afternoon. Could you consider some of that business?
Yeah,
taking off.
Yeah. So the big thing with that is that gives you the gateway to writing off 100% of the airfare. But hotel and meals and some of those other things, we'd want to only take the ones that are related to the business day. So the day that you potentially do that, we could take that day's hotel cost and that day's meals and things like that. But if you're there for 6 days and the other 5 days, we would want to keep that personal. Yeah.
A real life example. We're all going to Puerto Rico, all three of us together, for 10 days. If we had a meeting every day.
Team building event of some kind.
Puerto Rico team building. Then we can write the whole thing off.
Yes.
Every day. Oh, we're going to Puerto Rico. Man, that is awesome.
You just want to justify. We did truly have a business purpose. This was a team building event. This was
Every morning you'll have breakfast together.
And write it off.
Yeah.
We'll sit on the beach and talk about business. Okay. Which literally we probably will. We're all going to be working all day.
Right. And most of the time you are, because you've got your laptop
Up with you, you're getting phone calls. So yeah.
I do have a question. So whenever you're in another country, and your fees, your out of the country fees, do you write 100% of that off?
Well, if it's because of a business, purpose, like, hey, yeah, you would. So if it's travel, and we could write off 100% of the fees that are related to airfare or the hotel, but it's just if you're also kind of doing a personal vacation that you can't really justify as business, then we potentially want to allocate some of that as personal and not deductible.